What are we going to do today? There are certain topics that we're going to talk about. We are still continuing on with gross income. Now, see, you have to understand there's a lot of overlap between the individual taxation items of gross income and the corporate taxation items of gross income. So, what we're doing today actually is covering the business income also to a great extent. And the same thing would also apply for the deductions, right? So we are targeting a lot of gross income in individual taxation. We would target a lot of deductions when we're going to do corporate taxation. Okay. So what are the topics that we're going to do today? We are going to talk about first the capital gains. I'm just going to give you the concept here, but we are not going to delve deeper into this. So people who are following New World, this is one area which they have given in the gross income module, but we are not going to do it right now. Why? Because the knowledge is going to be half. We're just going to talk about one aspect, which is the income generating aspect. So I don't want to discuss it like that. When we do it, we'll do a full thing. So we are going to I'm just going to give you an overview of this and I'm going to leave it today. Then one very important topic. So actually there are a couple of things that we are going to do. We are first going to do capital gains, just the overview, nothing else. Then we are going to talk about rental income. Now this is a big ticket item and this is good enough for you to even get a SIM. So I would want you to do it a little carefully. The third topic that we're going to do today is, again, this is a new addition in your syllabus. We did not do this in a lot of detail in till last year. So this is called, okay, let's not call it IRD, let's call it income, gross income reported for a dissident. So I think it was Anirban who was talking about who fills the final return, what all other parties involved. Now, this is a new addition, guys. So I would expect definitely some MCQs from here. You can get a small sim also from here. Okay. Now, see, the reason we're delving in a lot of detail right now is first time. This is the first time that you guys would be tested for a new syllabus, and the category of sims that they're going to test you on has actually become a little more in depth from this year onwards. You'll get an idea when we do the sim today. Okay? So this is a new edition, and again, I'm going to give you the whole picture. I don't expect them to put you a question on everything, but even if you get a small MCQ, that will test your understanding of the base concept. Okay. Apart from that, we are going to run through some basic uh, other items. Now, here I have given you a list of lot of other small stuff in gross income, and this is where your MCQs would come very handy, guys. Okay. There are small things like damages, awards, emotional stress, what happens if it's a life insurance premium. So we are going to discuss all of that here. With this, we'll be completing the gross income aspect. And then we have two more topics, which is again the new addition. If you go back to our initial class when we had the orientation, there are two topics that they have introduced. Now, not every area will be tested for this, but I, again, as I told you in the first class also, it's a good idea if you can keep a copy of the AICPA new syllabus and all the topics which has been highlighted for analysis and discrepancies. These are the two topics that I would want you to dig very deep, because the kind of sims that can come in this area will actually need a lot of understanding of the base concepts. Okay, so whatever we have done till now, you will see how it will come handy when we're doing this sim. So this is basically when they give you a lot of scenarios. So the sim that we're going to do today or tomorrow, I don't know how much time it's going to take, because this kind of detailing I have not taught earlier as far as my CPA batch is concerned. Okay, so my suggestion is don't rush now. Once you get an idea of what kind of sims are being tested, then for the others we can be selective. You know, when I go to the other topics and I feel that the sims are not that complicated, I will, because by that time you will get a hang of how to approach a particular sim. Okay, so this, the sim that we're going to do today is going to talk about a real life scenario. There's a person who's come to you and asked your help for drafting her form 1040 with the schedules. And that person, and what they've done is they've given you a filled up form 1040, a filled up form 1040 schedule 1. They've given you everything as a supporting documents. Okay. And they've messed it up stating that, see, she has filled up or he has filled up these items. This is the information given to you. Now, you tell us first what should be the actual items, how should be the tax impact. So, if I'm talking about, let's say, gross income, Then they are going to ask you, okay, if it is gross income, tell me, they'll give you a full scenario. Half of the information will be given in the body of the sim, half of the information will be given in the exhibits. You have to correlate everything. So, what is included? What is excluded? So, this is basically what we have done so far. If you remember, everything that we've done in gross income, every single topic, they're going to take, and then they're going to complicate it by messing up the date somewhere, by messing up some of the other information. And then they would expect you to think through, and in your examination hall you should be able to pick out all the relevant details. First you fill up this, so said I've given you certain data that you'll have to fill up, and then they have put this date. So this is not something that is asked of the question, guys. This is your workings. From here you will have to flow that data in the actual form 1040, in the actual form schedule 1, and then and then the sim also goes ahead and asks you, okay, tell us, where did she make that mistake? What were the areas in which the mistakes were done? So you have to correct the form 1040 and 1040 schedule 1. This is a complicated one. And the idea is, once you know that this is the kind of question that can be put, every item that you do as a theory, that has to be so solidly done that you can answer a question that comes in the sim. This somehow I find the last topic a little simpler, because you will see that they will give you the data, and then they'll tell you this is the error report that has been generated. And most probably, because I am yet to see a sim where they have given you a lot of options, but the solution typically is a little simpler than the analysis portion. So if you crack this I think is easy and it's manageable. Okay, so this is the entire stuff that is left in gross income. I would see how much we're able to do today. Okay, so I have kept today and tomorrow's class for it. Whatever time is left, we'll start with adjustments. Okay, the kind of time that we took in gross income, this is not going to be the same for the others, because the periphery for gross income was huge. But for the others, I think it will fall within the schedule that we have set. Okay, so what are we going to do? First thing is, this is again, after we complete the individual taxation, we'll start with capital gains and loss rules. This is, I think, the most interesting part of US taxation. Okay, because unlike the Indian laws, where we have complicated a lot of stuff, there's a rollover required. We have to buy a new property within a particular time period. For different kinds of property, the definition for long term, short term are different. In the US, things are pretty plain vanilla. They have told you that if you want to calculate capital gain or capital loss, you have to just first take the amount that you realize. Now, the amount realized calculation, there are a lot of stuff, right? In the real world, you can have some of the debt cancelled. In the real world, the party can. So, the best example would be, let's assume I X here. Okay, let's assume two people from the class. Let's say we have Ketan and Jaishankar here. Okay, Ketan is a buyer of a property and Jaishankar is the seller of the property. Okay, so let's say Jaishankar has a property which is taken on EMI, and that property is now, he wants to sell off that property along with the EMI to Ketan. Now, when Ketan takes over that property, he takes that property along with the loan burden. So the amount realized will also have the portion that belongs to the liability, which is off from Jaishankar's head. So like that, we have a little bit of complications here. They'll tell you what is amount realized, the fair market value of the goods, the liability taken over. So the first, I think, is get us how much money in effect is being paid by Cayman to buy that property. So that's the first thing. Now after that, they'll ask you to reduce the adjusted basis of the property from here. Now this is actually interesting, because what they've done is they've envisaged that there are typically three possibilities where the property can come to Jaishankar. The first is a plain vanilla kinds. All of us know that Jaishankar goes and purchases that property. Very good. So he goes, purchases that property, and now here we have a tie-up with with the gap, which is very simple, right? We take the cost of buying that property, bringing it to the present location and condition and fit for its expected use. So typically, fixed asset capitalization rules will come here. Second situation is, what if that property was gifted to you? Okay, somebody gifted that property to you. You have a big godfather or a big godmother, and that person left behind a property for Jaishankar. If that happens, and here actually we are not doing with gift taxation as it's not a part of your syllabus, but you'll see that the person who receives the gift rarely would pay any amount as a gift tax, because the gift tax, if at all is imposed, is always imposed on the person who is, yeah, is always imposed on the person who is giving the gift, never on the recipient of the gift. And in the end, we have an inherited property. Now, here we have Jay Shankar having a very strong lineage, and his granddad has left around a lot of property for him. If that happens, here you remember we spoke about the fact that dying is a taxable event in the US. It's a deemed sale. So here the concept becomes different. Okay, because here we're going to talk about how the property has to be revalued to the fair market value on the date of death or 6 months thereafter. So here we are going to learn about certain rules of how are you going to find out the adjusted basis of the property when it is purchased, when it is gifted, when it is inherited. There is no indexation concept, guys. Okay, so we don't bring it up to last year when it was bought, what is the indexation. That entire concept is not no longer there. We just have the amount realized, the basis of the property. The basis of the property depends how that property came to your possession. And then we have the delta. Either there would be a gain or there would be a loss. If it's a gain, general rule is it is always taxable. So if I have made a long or a short term capital gain, now whether it is a long term or a short term capital gain will depend on how long did you hold that property in your hand. Sorry, it is long term capital gain. So general rule, if you've held a property for more than 12 months, it becomes long term. If it is less than 12 months, it is short term. And general rule, if there is any gain, that is always taxable. But they have given you exceptions. And this is what you will have to talk about. We have already covered one exception. Can anybody tell me which exception have we covered? Let me see who answers this. We have already covered one exception in our sessions. Can anybody tell me what is that exception that we have covered for capital gain property that will not be taxed even if there is a capital gain? Anybody? No. We spoke about it. Very good. Who is this? Ketan. Excellent. Divorce property settlements. We spoke about it, right? Whenever there is a divorce property settlement, even though the ownership is changing, but we are not going to tax that property. And even if there is a gain, we are not going to treat it like a gain. So that was one of the exceptions. Like that, there are, I think, 7 or 8 exceptions. And this is what we have to keep in mind. Similarly, uh, general rule that losses are allowed as a deduction. So general rule, you're getting a capital loss, it is allowed as a deduction. But then there is an exception, and these are the exceptions again that we're going to be careful about, right? For example, one of the exceptions I'm telling you is related party. If two related, let's say me and my brother, we enter into a transaction and I end up selling the property to him at a much lower price than what I would get had I sold the property to the general public. If that happens, then IRS says that, see, this is not a transaction at arm's length, and the losses that you have incurred, that will be disallowed to you. Okay. So all of those exceptions are something that we're going to learn when we're doing capital gains. So if you look at capital gain, the concept is pretty simple. Find out the amount realized, find out the adjusted basis of the property, calculate the gain, know the exceptions, calculate the loss, know the exceptions. That's it. This concept gets a little more tricky when you go and do it for corporate taxation, because there we have this concept of depreciation, that concept is actually a little complicated, so I have to see how much is it, have they increased, because we didn't take it to that, because that is one part which is really dicey. So for corporate taxation, when we're doing capital gains, capital losses, it will become a little tricky, but for individual, this is pretty simple. Okay, so this is all that we're going to talk about right now. When we go to capital gains, we are going to delve a little deeper on this. So any questions that you get in this area, and it's not difficult to know that this is capital gain. They will tell you this is a long-term property, land, stock, we are selling it. So people who are doing it from New World, don't do these questions when you're doing gross income. Okay. Always remember, if it's a stock and I'm selling off the stock, then you are always calculating the gains and losses on the date when the trade happens, not on the date when the settlement happens. Okay, which is also the norm which we have in India. So that's not an issue. Okay. Now, this is important because we're talking about the rental income. So, typically, we're talking about Schedule E. That means passive income, things in which you are not actively involved. Okay. So, here, this is the part that we're going to elaborate a lot today, which is rental real estate. So, I am, let's say I'm just working, I'm an employee, and I have some extra money. I go and invest it in real estate, and then I put it on rent. That amount is passive income, and unless and until I'm actually actively engaged and running it like a service department or an old age home or something in which I'm providing much more than just a rental contract, unless and until that happens, the income that I receive in rent, it will always be booked in Schedule E. Then there are other forms of passive income like royalties. So the best example is the movie rights, the rights for a particular book, all of those would be royalties. Partnerships, S corps, and the estates. When there is an income that you make from there, you will see a partner in a partnership or a member of an S corp. Since these are flow through entities, when you are a member of an S corp and the S corp generates money, the portion that belongs to you, there is a partnership which will file a form 1065 or an S corp which is filed a form 1120S. They will give each partner or member something called Schedule K1. We are going to see this in that detailed sim today, that how there is a person who's also an active member of an S Corp, and the S Corp gives a Schedule K1. So each member gets a Schedule K1 stating this is their share of income in the S Corp or the partnership. And the individuals have to put this K1 for all the partnerships and S Corps for which you are a member, put it in your Schedule E, and then pay on that income. Okay. So this again, I'm not going to delve a lot now. I'm going to talk about it when we are going to go to partnership taxation and S corp taxation. Okay. So estates, trusts. Okay, I think we have a wrong thing here. We have, sorry, this is this actually. This. Okay, they'll give you a K1 and you'll have to incorporate that in your books and you have to pay tax on it. So let's start with the renter. So I'm not describing a lot about the partnership and S corps now. We'll do it later. Now, see, what are we going to have now for rental income? Now, see, the question is this, right? The IRS is very clear that if you are generating income and that income is just a passive income, you report that income in your books. That's your rental income. Now, here there will be concepts of rental income inclusions or exclusions, or if you're just running it as a passive source of income, then how are you going to report it in your books? Couple of things. I don't know if this is there, at least theoretically, we've read it. People who are there in the US and who have some experience with the rental contract can pitch in. But when you look at it theoretically, they tell you like something like this. Let's say you've got into a contract for 3 years. Okay. So you've got into a contract for 3 years. A is a landlord, so he's a lessor, and we have B who's a lessee. Okay. It's a 3 years contract. The lessee would pay 6 months deposit and last month's rent in advance, which is non refundable. What do you mean by that? And this is something that is not there in India. So we never say that we take a last month's rents in advance. Okay, but I think there is a logic to it because when the lease is being left at that point of time, we wouldn't want the person to escape paying the lease rent. So if you have something like this, what does the IRS law say? Now, see, this is again tied up with the base concept of receipt, cash, and the accrual system. What did we say? Every time there's a pre-received income, which has been for which the person does not have to pay you back the money. There's no refundability element which is involved. You will offer it to taxation in the year of receipt, even if you are a cash basis or an accrual basis taxpayer. So in this case, if you get a 6 months deposit, which is refundable, and if you get a last month's payment of rent in advance, and let's say, so this guy, when he enters into a lease, he will pay you 2 months rent, the month in which he is entering, and the last month's rent. So we say 2 months rent would be offered to taxation in. So let's say this was December when the rental agreement got into. So we say that since the entire amount now belongs to the lessor, and lessee under no circumstance will have the right to get that money back. Both the amounts for the last month's rent and for the current year month's rent, both will be offered for taxation in the year of receipt, which is year one, December, when you've entered into an agreement. Okay, so this is what you need to know in rent inclusion and exclusion. So there are a lot of such criteria. What is included, what is not included. Okay, and if it's a plain vanilla rental contract, if you are spending some money to generate that income, can you get a deduction on account of that? That's the question that they'll ask you. Why? See, personal losses are never allowed as as a tax deduction. Whatever they will allow, they will ask you to put it in Schedule A, which is itemized deduction, and that is the only area where personal deductions or personal losses can be allowed, if at all. So they have given you a list of what are the items that we will allow you to claim personally, and if it is not in that list, that loss is disallowed. So what are the common core which runs throughout the taxation concept in US is, if it's a personal expense, you don't get it as a deduction. So when you have got a rental income, it is a purely passive income. Even if you're spending money, and if you feel that there's a depreciation of whatever add-ons that you gave or something, that will be disallowed because that's a personal portion of the property. You will just offer the income for taxation, and no expenses will be allowed to you. Only if you're running that property as a business and managing it as a business, that is the time when you get business income, less business expenses deduction, and then the net amount goes to your Schedule 1040. So, one thing always remember, if it's a personal expense or if it's a personal loss, the only place where it features is in Schedule A. If it isn't there, if it isn't provided to you, it will not go anywhere. So here, what they have done is, when they have described you the expenses, general rule, if it's an expense, only to the extent, some basic extent, it will be allowed. But things like utilities and depreciation, all of those expenses will be disallowed if the property is being treated as a passive property. Then there's a small exception. Okay, what if we have a personal home, and then we also have a vacation home, and we are using the vacation home not for rental, but we are not using the vacation home for personal purposes also throughout the year. So what we are doing, we're using it for some part as personal and for some part as rental income. I lease out that property for some part, but it is not a purely rental property and it is definitely not a business property. So in those situations, there is a distinction between how much expense they will allow for a property which is deemed personal and deemed rental. So that kind, when it is a deemed personal plus rental, if it is a property like this, then there's a small exception where they allow you a little more expenses than what they allow if it's a purely passive property. So that's the only part here which is important. Okay. Another thing is, they are going to talk about some loss limitation rules, which again is a common code in entire US taxation, that if it's a passive activity loss. So if you're passively holding a property and if you've incurred some losses on it, you cannot offset it against normal heads of income. You will have to wait for a passive income to offset a passive loss. Okay. So here we want to discuss a little bit about the loss limitation rules and for personally held property. There are some exceptions to the passive activity loss rules. That means if there is a property that you have taken on, if it's a personal property, you have put it on rent. So most cases, you cannot set off that loss against other heads of income. But there are certain exceptions where they will allow you to a certain extent to knock off that loss against other heads of income. So in this example, in this entire thing, in the rental property, there are three topics that you've got to be careful about. One is what needs to be taxed. Okay. What needs to be included in income. So if it is rental income, what is it that you are including in rental income? That's the first thing. The next concept that's important that can be tested is this concept. If it's a vacation home, deemed personal and rental, what are the exception to the expenses that you can claim as a deduction? And the third concept is the exception to the rules that passive income, exception to the rules that passive income can only be offset, and passive losses can only be offset against passive income. can only be offset against passive income. So there are two exceptions that we are going to talk about. One is a mom and pop exception, and the other is a professional. So we are going to talk about those exceptions. Okay. So let's take the first one. Okay. So what is rental income? What is included? What is not included? Now, this is a big dhobi list. You will not get everything in the same question, but you should know all of it because small parts of it can be tested in MCQs, or if you get a sim, it is possible to get a sim from here. If it is cash, so whatever you receive from the tenant in lieu of the right to use that property that belongs to you for some time, that can be treated as rental income. So if it's cash, it's cash. If it's fair market value of property that you're receiving, so if it's giving you some stock in lieu of the property, that can be your rental income. Any bonuses? So just for the fact that it's a prime property and the landlord is asking for a bonus, that bonus again becomes income. Any amount received for canceling or modifying a lease. So I get into a rental contract, I am a lessor, and I give you 3 years' time. And there's a stipulation that if you cancel the lease before 3 years, you have to pay me some cancellation charges. Even those cancellation charges are income for me. So I'm going to offer it to taxation. Property maintenance paid by the lessee, please understand, in lieu of rent. So I'm supposed to pay the maintenance charges, but I'm not staying in that property. So whoever is staying in that property, I ask that person to pay that maintenance and then cut it off from the rent. Again, so that is property maintenance in lieu of rent. Okay. Fair market value of lessee improvements. So the lessee, now this is a real story, but my husband had a colleague who's in Gurgaon, and he had spent a lot of money in paneling the. He wanted to buy a property and he wanted to rent it to all the expats. Okay, this is a in thing in Gurgaon. So what he did, he bought a very premium property and he spent a lot of money in doing the woodwork and everything. And then when this guy came as an expat, he said, "No, I want a feel of India, right? I don't want this wooden feeling." So what he did, he put a whitewash on the entire property. He said, "I want white walls, the way that you get it in India." Okay, so let's assume that this guy goes in for that yes, false ceiling and all of that. All of that, if you do, if it is adjusted with the rent, then that is lease improvements. And if it is adjusted for rent, it will be taken as a rental income. Okay, this is very, very important market. Any kind of a prepaid rent, any amount of prepaid rent is both for cash basis and for accrual basis taxpayers. It will be offered for taxation right on the day when the receipt is happening. In my example, the last month's rent that we are getting now. Okay. Rental income from a residence, unless rented out for less than 15 days in a year. Because technically, we say that if you've rented out something for less than 15 days, it is so small that you forget about it. I'm not even going to offer it for taxation. Okay. And last, rental income received provided there are no significant services. If there are no significant services, then all the amount of income that you're receiving is rental income and you need to offer it to taxation. What are the stuff that will not be rental income? Please understand rental of personal property. So with that property, you also go and rent your car. The car rental you will not get as a deduction, or equipment you will not get that as a deduction. Okay. If you run it as a business, then report on Schedule C. Else, if at all, it just personal property income, not taxable. A lessee's refunds, any part that you have to give back to the lessee, not refundable, not taxable. Well, any improvement the lessee does and does not adjust it against the rent, not an income. And any rental income where you have significant services, it goes to Schedule C, no longer goes to Schedule E. Okay, so this is a big and I think a pretty exhaustive list if you look at it, but it's important because they give you a lot of small questions that are from this area. Okay. Now, this is very important. If you are not running a property as a business, in that case, whatever money you get as rental income, it goes to Schedule E, and from there it goes to Form 1040. Please remember, if there are rental expenses, you can only adjust it to the extent of rental income. So, rental expenses are expenses that you incur in order to put that property on rent. Okay. You cannot deduct a loss. Under no circumstance can you say that I have a rental loss. You can't do that. Okay. And third, when you deduct, you can deduct the mortgage interest, the real estate taxes. Only three things. Why? Because these are the things, because see, then it becomes a personal property, right? So a personal loss is allowed only to the extent of items which are mentioned in Schedule A, which is itemized deduction. So there you can take a personal interest, so any kind of a mortgage interest, any taxes, any casualty losses, because these are items that you do in that you are allowed as a deduction in Schedule A. So only those items will be regarded as a deduction. And if at any point of time a property is yielding you an income which is more than your expenses for 3 out of 5 consecutive years, it is generally deemed that the property is being looked at